Good afternoon, everybody. Thank you very much for giving up your time to join us today. I'll take the lead initially with the presentation, and then Andy and Max will also join at various parts to give further detail on some of the slides. As a starting point, I think overall we were pleased with our full year results. We've obviously had one impact from the COVID-19 pandemic, but my team has done a fantastic job in navigating us through those challenges. We've seen very strong growth in our rail technology and services business, which has been fantastic. And that has been underpinned by further multi-year contract wins, which continues to give us confidence in the growth of that side of our business. We continued our track record of success in acquisitions by adding iBlocks in March of this year. And iBlocks brings with it in particular some very innovative smart ticketing capability, which we're very excited about, and which we have a very strong pipeline that we're currently exploring. And overall, as an introduction, our growth strategy remains unchanged. The group is well positioned. We've got strong cash position to fund both organic development in new software and in new technology, and also to support our future acquisition plans as well. Max announced a few months ago his intention to, after 10 years with Tracsis, to stand down as CFO. And I'm really pleased that after a lengthy recruitment process, we found a brilliant candidate in Andy Kelly. So Andy, would you like to just take a moment just to introduce yourself to everyone, please?
Thanks, Chris. This slide just gives a bit of colour on my background. So you can see that my career has been spent in a number of listed businesses, multinational businesses in a variety of industries, mainly in finance roles. During my time at Anglo, I spent 4 years working in their in-house M&A and then in their in-house group strategy team. And for the last 8 years, I've been working for a business called Vitek, which is a listed international business which designs and manufactures products for the broadcast and photographic industries. And Vitek has been executing a similar growth strategy to Tracsis, so driving organic growth complemented by an acquisition growth strategy. During my 6 years in the head office, we completed 12 acquisitions, which were mostly acquiring owner-managed businesses, retaining the management team, integrating them as part of the group, and then looking to drive efficiencies in the back office functions as part of the value proposition. So I was the group controller of Vitek for 3.5 years, in charge of all the accounting and reporting matters. And for the last 2.5 years, I've been the finance director of Production Solutions, which is one of the 3 divisions of the group. Production Solutions is a £100 million revenue business, again, multinational, headquartered in the UK, but we've got quite large operations in the US, in Costa Rica, and in Japan. And I run a team of approximately 50 people internationally, heading up the finance and the IT teams there. And Production Solutions is actually one part of Vitek that hasn't had any significant acquisition activity in the last few years. So my day job, if you like, for the last 2.5 years has been much more focused on operations, on running the business, and trying to drive margin improvement. So I'm really excited about joining Tracsis. As the slide says, I start in February next year. So that run-in has given me really good opportunity to get to know the business, meet with all the senior management team, and in particular to work alongside Max between now and February and after that period to ensure that we've got a really thorough and smooth transition.
Great, thank you very much for that, Andy. One of the big things we've been really focused on this year within the group is actually more strongly integrating the business together. So since I took over as Chief Executive 18 months ago, we've been focusing a lot on how do we simplify our group message so that all of our external stakeholders really understand the power of the Tracsis group and the products and services that we offer into the transport industry. So basically, how we communicate that story is, as you can see in the graphic on the slide in front of you. So rail technology and services has 3 or 4 key growth drivers that sit behind it. And one of the key things to explain as part of this is that we have very limited exposure on passenger numbers. So about 1.5% of our total group revenue is actually influenced by the current situation where we have low passenger numbers across the rail network. And actually where most of our products and services are focused are on key components of the railway which are required, whether you have one passenger or thousands of passengers sat on a particular train. So those key areas for us are in operations and planning, which is all around how do you manage and a very high performing railway. The key customers are train operators, and it covers everything from timetabling through to how you roster crew onto the different trains. How do you actually schedule the rolling stock so that the trains are available at the appropriate time? How do you deliver those on time? How do you recover a service if it's impacted by a points failure or by any other kind of intervention during the day? And hence that piece of software, which is underpinned by something called Tracsis Enterprise, is a really important growth area for us. But it's not the only growth area. We have other growth areas within the digital railway space around remote condition monitoring, which is a business that performed particularly strongly last year and was one of the main drivers for our overperformance from our rail division. That business continues to see really strong demand for its services and sees lots of repeat revenue. So it's a hardware provider as well as having a software data acquisition layer around it as well. So we get the benefit of both. And in addition, we're also seeing strong demand for our safety and risk management software, which is another really important element of how you run the rail network in terms of minimizing fatalities, in terms of minimizing near misses. And that is a product called Rail Hub, which we're seeing significant interest from across the rail infrastructure space, from both people like Network Rail as the infrastructure provider through to a number of the large contractors that put people out onto the railway. And then the final growth vector for us is in customer experience. And really this aligns around our acquisition of the iBlocks business. So as everybody can probably tell, post the COVID pandemic, we are unlikely to see people buying yearly season tickets anymore on the railway. And what our smart ticketing solution around is about offering people that pay-as-you-go flexibility so that you actually always get the best value fare, but it's tailored to your particular needs. So you might travel 2 days a week, you might travel 3 days a week, you might travel 5 days a week. What it actually does is it makes sure that you as the consumer get the best value fare from each journey that you take. So we're starting to see some real interest in that. So our rail technology business remains very resilient. It has growth vectors, regardless of whether you have full trains or empty trains. And we continue to see strong demand across all of those different services. The other side of our business, which actually we're renaming away from being traffic and data services to data analytics, consultancy and events, which is far more in keeping with with the breadth of services that we offer. So that business has two standalone parts, which are traffic data and events. Those are the two businesses that got most strongly affected by the coronavirus pandemic. And in addition, it has two other elements to it. One is around what we call data informatics. So that is all linked to our business called Compass Informatics, which is based in Ireland. And that is all about how do you use and monetize the data that you have across the organization. So how do you use that data to make really informed decisions? And also, how do you track and manage the various assets that you might have geographically dispersed across your operation? So that's an area of focus for us and a real area of future growth. And then we also underpin all of our business by offering consultancy and bespoke software solutions. So that means that no two customers are the same, and we're able to offer a level of tailoring to meet specific customer needs. So the purpose of making these changes are that the group starts to work more closely together. We have a common message going into the marketplace around our key product lines. And it creates a real excitement both internally and externally about what we're trying to do as a group. As a real simplification of that page, this page here shows you how our revenue is split across the group. Our focus as a group overall from a strategy point of view is to increase our portfolio of software, to increase the amount of recurring revenue that we have as a group. So currently that accounts for almost 40% of our total revenue. Remote condition monitoring remains flat at about 10%. And rail consultancy is up ever so slightly at 5%. Then if you look at the data and analytics side of our business, data informatics accounts for around 11% of our revenue. And then traffic data and event traffic management, both of which have been hit from the coronavirus pandemic, are now at roughly 20 and 15% of our revenue, respectively. So A diversified portfolio, deliberately diversified to make sure that we're not too reliant on any one of those particular areas, but a really interesting set of growth opportunities for us across those different sectors. And in terms of the headlines, in terms of why do we think we successfully navigated the last financial year, overall, our revenue is flat pretty much on last year, but that is after a 10 million hit as a direct result of coronavirus. And we'll explain in a moment exactly the different elements to that. EBITDA is also flat at 10.5 million, but just being very transparent, there is a £800,000 benefit that we've got from the implementation of IFRS 16 accounting rules. So actually, on a like-for-like basis, it's 9.7 versus last year. And the majority of that EBITDA has been as a result of strong growth in our rail technology division. Cash remains very, very strong at 17.9 million. We have no debt, and that gives us a great platform both to fund organic investment and future acquisitions. We've already talked about the iBlocks acquisition, very exciting addition of Rail Smart Ticketing into the group. And then importantly, the business continues to win large multi-year contracts. We'll talk in a little bit more detail in a moment, but we've still got 2 large contracts in the final stages of negotiation. But we've already, even in Q1 of this year, have won 2 new large events contracts. We've won a large traffic data contract, and we are continuing to see new opportunities for multi-year rail contracts. So all of that gives us real confidence that there's still strong demand for our products and services despite the current challenges. We continue to invest in our software and we continue to expense everything, so we do not capitalize any of our R&D. And then finally, at the headline level, as I said as part of the introduction, we spent a lot of time integrating the group together this year. So we launched the shared services model in August across the group. We've launched an innovation hub to drive the next generation of research and development and to look at how do we better maximize cross-group opportunities to develop new products. We put in a group-wide CRM system to bring together our commercial activities, and we're also working on a new brand strategy to really just simplify the messaging around the group and to help people really identify with who Tracsis is and where we are going. So overall, we're very, very pleased with the outcome, and we're also very pleased that the team have done a brilliant job in looking after our staff and employees and helping everybody through what's been a pretty challenging time for everyone. So in terms of our COVID update, really just to give some specifics, we obviously had to, in March of this year, take some immediate action. Most of these actions will be things that you're familiar with from other organisations, but we moved to remote home working with immediate effect. The only part of our business that didn't was our MPEG production facility, which continued to remain active throughout the period. We have had to make use of the furlough scheme, and we used that for both permanent and casual staff in our traffic and data services division. And what we did do is we topped everybody's salaries up to 100% for the first 3 months of that period, primarily just to protect people's health and well-being and to make sure people didn't have too many other things to have to worry about. We continued our engagement with clients. We continued our focus on large project delivery, really just to maintain the status quo and to make sure we continue to build trust and maintain trust with customers. And then to make sure that we could robustly see ourselves through the period, we made just over £2 million of cost reduction actions. So that's a mixture of salary reductions, it's a small number of redundancies, and then it's a whole host of operational cost reductions, some of which will continue well past the end of the coronavirus crisis and will help drive some improvements in margin performance in the future. In terms of current status, every office is COVID secure. We have people back in some of our offices. That's very much a personal choice or in some cases driven by business need. We are still using the furlough scheme to a limited degree, but there is no top up. So it's just 80% on people's salaries if they are on the furlough scheme. And the group integration activities continue. In terms of our outlook, the rail business model is still not been impacted by coronavirus, which is great. And as I've spoken about, we've seen a number of contracts won in Q1, and we've got 2 large rail contracts still under negotiation. So if you take that picture in conjunction with a strong cash balance, with the fact we're still actively looking at acquisitions, and the fact that Q1 has come out in line with our expectations, overall, we're in a good space right now, and we're confident about next steps. So Max, would you like to just walk us through some of the financial impact from this year, please?
Yeah, sure. So you can see here 48 million of revenue, which was good, just down on last year, 49.2 million. Prior to COVID, the market forecasts were 55.4 million. So we think there's been about 10 million hits from COVID at revenue level, and that's been offset by a really strong performance in our rail division, and that's mainly in our remote condition monitoring part of the business, which has performed really well. As Chris said, we've seen a few events cancelled and traffic service postponed. But it's interesting to note that all the time new opportunities are coming in, and we've been involved in some of the COVID-related work, so that has helped mitigate the impact too. And interestingly, during the height of lockdown, we delivered a huge project for our traffic data business called NRTC, and that was really valuable and kept everyone fully busy. At the EBITDA level, we did 10.5 million this year. Again, the COVID impact there, we've quantified around about 3.5 million. So in terms of bridging the gap between the original pre-COVID market forecasts, we can see the overperformance from the rail business, which has been good. As Chris said, we've used the furlough scheme and implemented some cost reductions because our traffic data and events businesses were badly hit. But again, we've used the opportunity to accelerate some of the group integration. So that's been a really worthwhile exercise. In terms of the cash, we ended the year with just about £18 million, and that's having purchased iBlocks during the year. And cash is really strong. Cash generation and profit conversion is great. We've always prided ourselves on that, and it's continued even during the pandemic. So our customers are paying really promptly, and we've not taken advantage of any of the government schemes for deferring VAT, pay as you earn, or corporation tax. So the cash figures you see here are real, they're not overstated, and it just sets us up well for future growth, whether that be organic or M&A. And as you know, we've done 14 deals over the past few years, and we're always open for business. So just to confirm here, 48 million revenue, down 2.5% on last year, EBITDA of 10.5 million, which is flat, and statutory PBT of 4.1 million, which is adverse to the previous year. But I think in spite of the pandemic and where we found ourselves in March, these are good numbers. We're pleased with where we ended up, and to have got through the first phase and delivered some of the work we've done and set ourselves up for the future, I think we're pleased with what we've achieved there. And that cash balance is really strong. 18 million it sets us up really well. So there's plenty going on in the business. Completed the acquisition, looking at more projects for the future. We've delivered some of the large software contracts, and trying to increase our recurring revenue. So I think a message here is, we had a good H1, and then H2 was more of a challenge. Chris, back to you.
Yeah, so at the headline level, in terms of our rail technology and services division, we saw 17% revenue growth and 33% growth in adjusted EBITDA, which obviously are great headlines. What this page here captures is the 4 growth vectors that I spoke about at the start of this presentation, and it just really reinforces the fact that we are seeing strong demand across a number of different areas of our rail business. So whether it's in operations from the train operators, whether it's in infrastructure from organizations like Network Rail or their international equivalents, we have got a very strong platform for growth built around almost entirely recurring revenue and software. So this really underpins our confidence moving forward, and is also a key focus for our innovation hub activities. If you then look at the TAD side of the business, really the headline there is as we've said before, that we've taken decisive action to reduce costs. There was an 18% overall revenue reduction on that side of the business. A lot of the work actually hasn't necessarily been cancelled. A lot of work has been postponed and actually still sits in our order book, but can't be delivered until life returns to normal. So, for example, in a number of cases, traffic surveys are only carried out when traffic levels are representative of what you class as normal. And so in some cases, we don't expect that to return until the springtime. However, there are growth vectors on this side of the business as well. So We invested in a business called Vivacity Labs a few years ago. We continue to work closely with that business, and using their innovative AI software is actually quite an important part of our future growth strategy for our traffic data business. And then in our Compass Informatics business in Ireland, it's all around GIS and location analytics. So how do we better exploit the data and the opportunities that we have to use that data across the whole of our group? And on the event side, Max has already spoken about this. So despite the impact of COVID-19, we are continuing to win work. It's not at the previous levels, but we're winning work in areas that we weren't winning previously because opportunities didn't exist. So there are opportunities coming out, specifically around some of the challenges that coronavirus has introduced into the economy. And Max, do you want to just comment now further on some of the other sort of fundamental financial headlines?
So that 48 million of revenue was down 2% on a group-wide level. There's a 17% increase in rail tech revenue there, from 22 million to 26 million. And that's been offset by shortfalls in our traffic and data services division, given the challenges of COVID. So that leaves EBITDA flat versus the previous year. And it's worth just pulling out as a couple of points to make here. There's an impact from adopting IFRS 16 of about 800,000. And the net furlough benefit is about 700k in there as well. So, on a like-for-like basis, EBITDA and profits are adverse to the previous year, but the margin is still strong. And I think, we're very proud of what we've achieved in the year, given the circumstances, and that EBITDA margin's been maintained at a good level, really due to the higher proportion of rail tech revenue in there, which comes with a higher margin. And as Chris said, we have put a lot into our products over the past 12 months. We've invested continuously, and all of those costs have been written off. And we leave the end of the year with a good order book and a pipeline of opportunities. There's plenty going on, and we'll come on to Q1 in a moment. But I think there's some good stuff on the go at the minute. In terms of the cash flow statement, as I said earlier, we've always prided ourselves on the profit to cash conversion, and you can see that coming through in these numbers here. We spent that 12.5 million for the iBlocks deal back in March, and to end the year with 18 million pounds in the bank without having taken advantage of any of the government support schemes is a good place to be. And on the balance sheet, just very quickly, the 55 million of intangibles has gone up given the iBlocks acquisition. Debtors down given timing of the work and the good cash collection, and you can see the 18 million of cash on the balance sheet there. 7 million of contingent consideration, that's been reviewed and updated at the end of the year, and taken accounting treatment's been fair valued accordingly. But all in all, it's a good clean balance sheet that's very strong and sets us up well for the future.
Great, thank you, Max. So the final part of the presentation is really looking forward. And what do we think the future now looks like for the group? So we'll just start with the industry drivers. So these are unchanged from last year, but they continue to really underpin the strategy of the group moving forward. So at the highest level, we're looking at drivers like rapid urbanisation, big data and connectivity, and an overall enhanced performance. And if you look at the sort of breakdown of what do those things drive in terms of pressure on the transport system, the need for more integration across the transport system, greater connectivity, better use of data, a better understanding of asset performance, being able to forecast failures, mitigate against them, and whilst at the same time guaranteeing that that transport infrastructure is safe to use, are all factors that influence why people would choose to use the products and services that are developed by the Tracsis group. So at the bottom, we've just captured some of those headlines in terms of data acquisition and smart analytics, virtualization and digitalization. That's a huge driver across the industry right now. The power of remote condition monitoring in terms of providing that data. Then how do you provide that data in a real-time basis so you're not making decisions that are 2 or 3 weeks out of date, but you're actually making decisions in the immediacy of where you are. And then how do you make improvements in things like predictive maintenance and actually drive operational cost out of the railway by reducing the amount of time you have to be on site to maintain particular assets. And then behind all of that is then also a drive for hosted enterprise solutions. So how do you make sure large organizations all have access to the same data and hence can utilize that for the benefit of their organization? So lots of reasons to be really positive here about the future of the group and why we are well set to maximise our opportunity. If we then look forward, I'm going to ask Andy to comment on this, because this is an important part of why Andy has joined the team. So at the headline level, our 3-year growth strategy is unchanged. And Andy, could you just walk through to everybody the sort of key headlines on this slide, please?
You're right. No, for me, as someone coming into the business, this is one of the things I think is really exciting about Tracsis. There's a real opportunity to continue to grow the business, and it's built on, as Chris just described, a set of market fundamentals that really align with what Tracsis does. The business's capability in terms of its balance sheet and its ambition to continue that growth hasn't changed. And the slide sets out a very clear strategy for doing that, which again hasn't changed. So the 3 key elements of that strategy, firstly, in terms of organic growth, I think Chris has already touched on, the multiple opportunities for further growth in the rail space. That's both with our existing customer base and in terms of gaining further share. Not linked to the number of users actually on the railways, but actually much more fundamental factors around operating the railways. And it works right across the product suite. So not just with Trax Enterprise on the operational side, but also around asset optimization, risk management and safety, and customer experience. And alongside that, there's initiatives underway to ensure that the business can deliver further value from integrating the group further. Again, that's things like the innovation hub and embedding the shared services model that Chris talked about before. Alongside organic growth, acquisitions will still continue to be a core part of the strategy, supported by a very strong balance sheet and with a focus on software and technology businesses in particular. And thirdly, and importantly, the other key focus is growing the amount of recurring revenue that comes from our international opportunities. This is something that Chris has talked to me about ever since our first conversation about Tracsis, something that I'm very interested in, fits very closely with my background, and is a real opportunity for us to continue not just to grow, but also to further diversify the business. So as I say, I'm really excited about this. I think what's good about this is the opportunities are very clear, they're very tangible, and there's a very clear strategy for delivering them. Hopefully with my background, I can help to maybe bring a bit of fresh perspective and a bit of fresh thinking into how we can deliver this. Back to you, Chris.
So we've just got a couple of slides left to go now. So in terms of just to summarise a little bit more of the detail. So from the rail technology side, we expect growth to continue. So in the short term, as I said already, our rail business model is not directly impacted by low passenger numbers, which is great. It removes a large degree of uncertainty for us at the moment. And through this year so far, all license renewals have been secured and all ongoing large projects are continuing as planned. So each customer has said just continue to the original contracted milestones. Nothing has changed. The one thing we would just add, though, just to make sure that everybody understands the risk, is that the train operators are currently operating under short-term, what's called emergency recovery measures agreements, which use the acronym IRMA. Now, there is a risk potentially that means that there is a hiatus while train operators aren't able to commit to new long-term investments. We're still seeing tender opportunities, so we're not yet sure whether this will be a material risk or not, but we flag it just for people's understanding. The industry is moving towards what are called direct awards, which it expects to be able to start awarding those towards the end of the next calendar year. And those will bring back a longer term picture again for the operators of each of the major rail routes. So in terms of the overall outlook for rail, it's very positive. The government, even through its spending review this week, has made it very clear that there'll be significant investment to drive growth in what they call the digital railway. They're clearly putting lots of money into HS2 and into a number of other areas. So for us, the key growth vectors remain operational performance, they remain asset performance, enhanced safety, smart ticketing, and data informatics. And there is absolutely no reason why we can't continue to be very successful in each of those areas. On the other side of the group, the key headline there really is, even though there will be an impact and there will continue to be an impact from COVID-19, we are continuing to win new work, even in those businesses that are being impacted. So at the headline level, Compass Informatics, which is our Irish-based business, that's been unaffected and continues to perform really strongly. And we're looking at opportunities to now expand their capabilities across the rail technology space. We do expect there to continue to be a hiatus in our traffic survey work until probably the spring. The government is putting lots of money into active travel, which is a whole new set of opportunities that we're working with local authorities to access. And importantly, the large NRTC contract, that will continue throughout the period. So that is unaffected. On the event side, we are continuing to win work in new sectors that we didn't even know sort of existed, which have all come off the back of the COVID-19 crisis. And they really relate to wherever you're creating new scenarios where you're ending up with large populations of people and social distancing challenges and logistical challenges. They need the expertise of people that have run or been part of large event planning and large event delivery. So although we are still cautious on this side of our business, we do expect this side of our business to bounce back as soon as either a vaccine is available or the government gives the green light for greater mobility of people and greater movement of people. What we'll also see is some of the benefits from the cost reduction will also continue to carry on beyond the end of the crisis. Just an important point as part of our strategy moving forward, ESG is becoming an increasing part of our thinking and an increasingly important part of our strategy. We are in the process of defining some key metrics against which we will be tracking our performance. And on the left-hand side of this page, you can see our sort of outline thinking around the areas which we think we can most contribute to. So we're not a big production business. We're not a big consumer of energy and water. However, there are things we can still do with our property portfolio, with the use of renewable energy, etc., to make a difference. We operate a vehicle fleet. So can we move that vehicle fleet to being all electric? Those are all very much in our planning thoughts at the moment. And then we continue to look at opportunities to improve diversity across the organisation, both from the board level all the way through the rest of the organisation. So this is something that we'll bring to life more in future reporting periods, but it's something that's starting to form a really important part of our strategic thinking. And then finally, forward into 2021, what's our thinking? Our thinking is that we remain really confident about the future long-term growth of the business. Q1 trading has been in line with expectations, which is great. We've got 2 major multi-year rail contracts in the latter stages of negotiation, which is also really good news. So at the headline level, we're going to continue to drive innovation and deliver the large projects that are currently in play. We'll be capitalising on the pipeline of large multi-year contracts that we have across the group. We'll be continuing to fund M&A and continuing to extend our footprint into other areas of rail software and into other data and analytics offerings. And then overall, we're committed to our 3-year strategic growth and investment plan. So although we currently have challenges as a result of coronavirus, we remain absolutely confident in the long-term growth and strategy that we've put in place for the group. So that's the end of the presentation. Thank you very much.
And we have a question from Nick Cotton, who asks, how much is the investment in R&D?
It was about, I think, 2 or 3 million quid this past financial year. And all of that's been written off. We've continued to invest a lot in the products. There's some key work ongoing. So, yeah, we're not afraid to put the money in and for the long-term rewards.
And Bob Meadows asks, well, first he says, great presentation and progress, thanks. What are the major competitive threats that you have your eyes on?
It varies on a business unit by business unit basis. I think what we've always said in terms of the whole Tracsis group is that we don't see one major competitor who can do everything that we do, because we're quite diverse in what we do. But there are competitors out there, and we are mindful of them, and we have seen new entrants trying to enter the market, in particular rail, some overseas players trying to get into the UK, and we're mindful of this, and that's one of the reasons why we've invested a lot in our product development there. Our remote condition monitoring business has a couple of competitors, and that's fine. We believe we have a good offering there. And again, there's competition in the traffic and events businesses. Given COVID, people are being a bit more aggressive on pricing, but we're responding to that. The best thing we can do is be lean and mean and make sure we are responding to the competition. But we are mindful of it. We've always been mindful of the competition, respectful of it. But we have to believe in what we do, and we know firsthand that our clients speak really highly of some of the products and services we've got and the people we've got. We've got some great people, so that's all we can keep doing, just to mitigate that risk. You're right, you have to be mindful of it.
And we've got a verbal question from Jeremy McCohen from Progressive Research.
Thank you very much for the presentation. It was very interesting. Obviously, you've been making a few management changes, which you've referred to in this presentation. But I just really wanted Chris to get a bit more on this and what your background was. You said you'd been CEO for 18 months, what your history in the industry and the group has been, and just a little bit more background on how that fits in with the sort of the narrative of the company and how we should think about it going forward, because you've clearly built a very strong business, but it's reasonably complex for the size that you are, I would suggest. And you referred a couple of times to sort of having a unified CRM system, and I just wanted to get a better flavour for the cultural issues of tying it all together. And I think that's very important if you're going to grow the business or acquisition. Sorry, a bit of a rambling question, but I think it's sort of all part of the same issue.
No, I mean, that's a great question. I mean, I only joined Tracsis 2 years ago, or just under 2 years ago. So I've got a 20-year history in the transport industry working. I started in automotive working for Ford Motor Company. And then I spent 15 years at Ricardo, which is a public company engineering consultancy business, and had a range of roles from running engineering services, running software business units, and running international subsidiaries. So when I joined Tracsis, the intention was to kind of look at the group, and working with Max was then to look at how do we build from a very successful starting point, but recognize that there were some operational challenges that we needed to address in terms of collaboration, common platforms, common thinking. And I think that the beauty of the business is that we have a number of fantastic entrepreneurs who used to run their own businesses. And when you run your own business, you end up developing a really unique set of skills around entrepreneurship, taking risks, being very proactive in your commercial engagement with clients. And then what happens is you join a corporate, and then you kind of lose all of that because you're suddenly now in a much larger organization. So what I'm very conscious of is giving those individuals that freedom. And that's why Innovation Hub's been set up. That's why we set up the shared services model, so that we can get the best out of our entrepreneurs to actually further exploit the opportunities that sit across the group. So it's very much about getting more out of what is already a very successful, very focused organization, but just making sure that we're all very clear on what's the strategy, what we're trying to achieve, who are our key customers, what are the problems we're trying to solve, and to do that in a way in which we're getting the best out of people.
And we've got a few questions on the United States. Mark Cox asks, he says, great presentation, thank you. Do you have an update on the progress in the US market? And Douglas Gill says, is there a catalyst that will help with this potential?
US continues to be very slow. There's two fundamental reasons for that. One is the market itself is slow. However, we've got to work out for ourselves what structure will work for us in the United States. So we have a reseller currently who's been successful and has won a number of small contracts for us. We've conducted a big M&A search activity in North America to try and find a target entry point for us. I guess the big positive from that was that we didn't find anybody that looked like Tracsis, which is great. It means there's a big market opportunity, but the downside is there isn't anybody we can acquire to make a quick entry into that market. So that was one of the particular skill sets we were looking for when we hired Andy, is somebody that has got international experience, very recent international experience, and can work with me on looking at, well, what is that solution for the US market? So I think we remain committed to the fact there is an opportunity that is worth chasing in that marketplace. but we've not yet put in place the structure or define what that's going to be to enable us to go and chase that market. And the biggest mistake we could make is myself and Max, or myself and Andy, spending 90% of our time chasing 5% of our revenue. So we've got to get that platform right, so that we can then take the appropriate level of risk.
Yeah, I think that the only thing I'd add to that, and that's a fair assessment, Chris, would be you mentioned a catalyst, and we won't get into the politics of America, but an end to COVID would perhaps be helpful. A vaccine might help our US sales agents do a bit more travelling, and it's tough at the minute, and as Chris said, it's slow going, and that's all we can say.
Thank you. And Tobias Kastenhuber asks, what percentage of rail operators do you currently have on your rail enterprise platform? I think in March it was 40%.
We work with a vast majority of train operators for various products. Some have got one product, some have got 10, and any number in between. In terms of enterprise, we've announced, I think, 3 contracts over the past few years, and they're at various stages of delivery right now. And that's all we can say. And we know we're targeting more. We see huge growth opportunities there. We'd like to win more in due course.
And just something to add to that, Tamsin. I mean, we have a map of all of the train operators and what we think is the size of the market opportunity for Tracsis Enterprise, and we think we've got probably on there 30% of that market maybe right now. So it's a significant growth opportunity for us.
Thank you. And John Hanna asks, why is there such a gap between adjusted and statutory profits? I understand the amortization of goodwill element on acquisitions, but what else is behind it?
Yeah, there's a big, amortization is the biggest number. There's 3.6 million in there. There is a big depreciation charge this year, given the first year adoption of IFRS 16. There is a big share-based payment charge of £1 million, and that's not for the directors, by the way. That's for staff, all of which participate in that scheme. It's a great scheme. And then there's a couple of exceptional items. We took an impairment against against one previous acquisition and one investment, and then there's some fair value adjustments for the contingent consideration, which we've put through as well, plus a small share of the results of some associated undertakings. So all of that adds up to the difference, really. And it's the same as in previous years. There is a difference, and investors need to take their own view on what are valid. Which reconciling items are valid, I guess, and people can form their own opinion on that. We give investors full transparency. We present the accounts in a very clear way, and people can form their own opinion.
And Barry Singleton asks, what's the continuing involvement of John MacArthur in the business?
So John continues to lead all of our M&A activity. So John is doing what he loves best, pursuing a range of opportunities for us at the moment, and he works together with Max and I on a regular basis, doing everything from chasing pipeline through to heads of terms, leading all of the due diligence activities, right the way through to deal completion. So John has no involvement on the operational side, but remains very heavily involved on the M&A side.
John was instrumental in the iBlocks deal as well. He did a lot of the work on that, and he's still with us looking at other deals.
Thank you. And Eric Burns asks, can you give more background on the risks surrounding TOCs and ERMAs at the moment? What are the long-term implications for Tracsis?
Okay, right. So I'll just give a sort of a 1-minute explanation as to what we think is going to change in terms of the railway structure. So in its structure pre-COVID, each train operator largely took the revenue risk. So they would put forward as part of their franchise bid what they felt they could generate in terms of revenues, and then they were responsible for running the railway. Clearly, when the coronavirus crisis hit, there had to be a different mechanism put in place because suddenly revenue evaporated. So what were first called EMAs then became ERMAs, are short-term contracts basically to ensure the train operators can continue to run the service, continue to make a small management fee to justify running that service. But the revenue risk is basically taken by the government. Now that clearly can't continue in the long term because as the the government said yesterday it's costing the government significantly hundreds of millions of pounds a month to subsidise the railways at the moment. So what we understand is going to happen is that the industry is now going to move to direct awards, which are going to be new long-term contracts. They're going to be called based on concessions. So a concession, one of the operators already runs a concession. So that is Southern, so what's called GTR, which is Southern, Thameslink, Great Northern and Gatwick Express is already a concession. And what that means is that rather than taking the revenue risk, an operator runs the railway and earns a management fee in return for running the railway. What's believed to happen moving forward is that under the direct awards framework, they will then be penalised for poor performance or for missing key KPIs around the way in which they operate that railway. So moving forward, you will end up walking into a situation where you take on a particular franchise, you know you're going to get a particular management fee, but then if you fail to deliver customer experience targets, performance targets, cleanliness targets, whatever else it might be, you will be penalised. So the way we're interpreting that as a business is that's a number of those elements are exactly what a product like Tracsis Enterprise is designed to do. It's designed to enable you to operationally enhance and maximise your service provision. And that's exactly what things like our remote condition monitoring system do in terms of enabling the infrastructure provider to monitor the performance of the tracks and the overhead lines and the signalling and ensure that that is fit for purpose at the same time to enable that service to operate. And then on the customer experience side, it's going to be all around ticketing, delay repay, which will all be around compensating people for poor experience. So for us, the way we're interpreting those changes is that all those changes are very much heading in the direction of the products and services that we as a group already have available or are enhancing as part of our development plan.
Yeah, I think that's a good summary, Chris. I think the only thing to add to that is what you said on I think it was the second to last slide, which was there might be some short-term challenges while the talks are in these IRMAs, and will that affect their ability to procure long-term? We don't know, but once you get beyond that, exactly like you say, in the medium term, it should be in theory be well set up for a range of products and services that Tracsis can offer.
Thank you. And we've got a few questions about director shareholdings and how directors are incentivised to think like the owners. What is the director shareholding?
0.6%, of which I am a large share in that, and some of the other non-execs have share holdings themselves. None of the so Chris has got some share options. Andy will get some share options when he joins. None of the non-execs have share options under good corporate governance. John MacArthur had 3%, but he's now stepped down as a director. So there's a mixture in there. It's a personal investment decision, really.
Yeah, and we're all incentivised by long-term 3-year share incentives that are aligned to EPS growth for the business. So we're incentivised in exactly the same way as all shareholders are incentivised. And then we're also entitled to a short-term cash bonus as well, should the business hit specific PBT targets in any given period, or personal objectives that we're being set that align with the strategic direction of the business.
Thank you. And is there an opportunity for you from Crossrail?
Yes, and we're already doing some stuff, I think, with them across various parts of the group. I won't go into detail, but they are a client of ours on various bits and pieces. Yes,
they are going to run operationally probably until 2022. So there are some activities, but they're not going to be fully exploitable yet for probably another 18 months.
You've covered off the USA. Is there anything happening in Australia? And for both the USA and Australia, or international markets generally, are there some key milestones that you're looking at?
In Australia, we have got a number of opportunities that we're currently working on. One is a significant one. So we're actually working to find a local partner, so somebody that can help us with the local on-the-ground delivery, especially if restrictions continue in terms of mobility of people. And so our key thinking is that Australia is likely to be a model that we continue to develop through a reseller, and that reseller would look at New Zealand and Australia for us. We've already got a small footprint in New Zealand already in terms of our product footprint. And the US, we've got a reseller model already, which is kind of, it's okay, but we need to look at what do we do next. The model for the US is likely to move to something a much more permanent Tracsis entity. Mainland Europe is going to probably just remain speculative for now, in that we've got so much opportunity here in the UK, and we're the strong incumbent in the UK. I think Europe would be a distraction for us in the short term. But it's not to say that couldn't materialise in the medium term, but right now the UK remains the priority.
And are there any key milestones that you're working towards in the international markets?
No, the key milestone is Andy joining, and then Andy and I sitting together and kind of looking at just what are we going to tackle, and how do we do it in a timeline where we can make some clear decisions around the plan. As I said, we've done the M&A search. That hasn't thrown up any immediate answers for us. The next step is to then say, okay, well, what other opportunities have we got to enter that market? So I would have said by this time next year, I hope we've got very clear milestones and a very clear plan.
And in the remote conditional control segment, you fulfilled a large contract last financial year. Do you expect revenues to decrease in this segment for the current financial year?
It's a project-based business, and revenues in that part of the group have varied between 2 and 6 million, and anywhere in between. So we to answer your question, on one level, yes, we had budgeted a lower level of revenue, but Q1 trading has been really strong in that part of the group, and we expect it to continue. So the early indications of the new financial year are that it will be more of the same. In the past 2 years, it's done close to £5 million of revenue in each of those 2 years. So on the one hand, it might be due a drop-off at some point, but equally, there's no indication of the demand slowing down, and that's testament to the great product and the great team that we've got in that part of the group. And it's doing well at the moment.
And we've got a verbal question from Patrick Baddeley. Patrick, go ahead and ask your question.
Thanks very much. How much of your revenue at the moment comes from outside the UK? And linked to that, how easy is it for you to migrate your UK products into another jurisdiction, into another market? How much R&D, sort of tailoring of the products, do you have to do to get it fit for overseas markets?
Mm-hmm. Well, we have an Irish subsidiary called Compass Informatics, and most of the group's overseas revenue comes from there, which is about £6 million in the past year. It's in the segmental analysis in the announcement this morning. We have done bits in Sweden, bits in New Zealand, and bits in America, and that's taking our core products in the UK and exporting them to the States and adapting them slightly. And the New Zealand version is very easy. There's no extra work needed there, and I think the Swedish stuff had to get translated a few years ago. So it's not a major piece of work, but as Chris said, the focus is really on the UK. There's plenty to go after over here, and any overseas exploits are lower down the priority list. But we do. I think it's about 12% has come from mainland Europe. We could do a bit more, but not in the short term. Let's focus on the UK and making the most of the opportunities that exist over here.
Yeah. The only thing to add to that would be our MPEG product is the most easily exportable. Yeah. So if you take that product from the UK to the US, I think broadly it's just the power supply change.
Yeah.
I might be simplifying it a little bit, but it's broadly. if you take something like Trax Enterprise into America, they have a slightly different take on life. So they call it crew calling, whereas we call it crew rostering. And there's quite a difference between those two phrases in terms of the legislation that sits behind it. So MPEG and remote condition monitoring remains the area to go to first. And then in an ideal world, we'd create a platform for growth for that, and then we'd then build a software offering off the back of it.
And Terry McDonald asks, are Tracsis products adaptable to other markets, for example, logistics, in order to expand your market?
They are. I mean, to be honest, the most logical place to move them is into something like from rail to bus or into other transportation type arena. The logistics question, interestingly, has been asked by a number of people. The answer is yes, but I think that would require quite a series of modifications, and our worry would be, does that just distort our thinking and our focus on the markets where we know we've still got a significant market opportunity.
Thank you. And can you quantify the COVID impact for 2021 compared to an underlying year?
A similar amount to this year, we expect. I mean, it's great uncertain times at the moment. We don't know. We would anticipate probably another 10 million impact. And if you look at the FinCap numbers that have been released this morning in terms of forecasts for next year, so the 2021, they're looking at about 50 million. And assuming the world gets back to normal in the year after, I think it's just over 60. So that feels about right. And what we've done based on our internal budget assessments, which have been prepared by the team on a bottom-up basis, that's pretty much in line with what they're saying. So about 10 million revenue hit, and there will be a profit impact as well, but not on that magnitude, obviously, because part of that is casual labour, which won't be required for certain events and traffic studies. And also we've taken out a lot of costs. So what we said for 2021 is we're looking at, well, FinCap has suggested about 50 million revenue and 11 million EBITDA. I think we're comfortable with that. And, but, I think COVID's probably put us back a year. And that's why you can see the 2022 numbers resembling what FinCap were suggesting pre-COVID.
And a question from Vivek Sharma, who asks, if it's group policy not to capitalise development costs, what's the rationale for technology being capitalised on acquisition versus recording this as goodwill?
Well, we don't meet the criteria to capitalise development costs, in our opinion, and that's on the stuff we're developing internally. When one buys a business, one has to do the purchase price allocation exercise, which has been a big exercise this year, given the iBlocks acquisition. And it's a different accounting argument. It runs under IFRS 3, which is the purchase price allocation, as opposed to the basic development costs. This year, given the iBlocks acquisition, we engaged some external experts to help us with the exercise, which was a very comprehensive exercise, and we took their advice, and they gave us the split, in their opinion, between technology assets, customer-related intangibles, and goodwill. And it's an extremely comprehensive piece of work that they've done, and we've used that as the basis for our accounts.
Great, thank you very much. And that's the end of questions. Chris, do you have any closing remarks?
I think only as a closing remark, the only thing I'd say is a huge thank you to Max. He's been an absolute key part in the success story of the Tracsis business, and after 10 years in the role, obviously this is probably his last roadshow. Really, it just leaves me to say thank you on behalf of the company and all our employees for his contribution, huge contribution to that success story. And also to say thank you very much to everybody for your time today.